needed to be eased. The starting point for interest rate cuts was correspondingly lower here than elsewhere. The Swiss franc has thus remained fairly stable since September 2011. Were it not for the negative interest rate and the extensive interventions by the SNB, Switzerland would today be facing a different economic reality. The franc would have become much stronger, inflation would have fallen well below zero. Growth would have slowed abruptly and unemployment would have risen markedly. For us there is thus no question. That the negative interest rate was significant in helping Switzerland emerge from a difficult period in good shape. And it is still making an essential contribution to ensuring that our economy continues to fare well today. Despite the array of uncertainties worldwide. But how exactly does negative interest work? Safeguarding Switzerland, ladies and gentlemen. Would the citizens of Switzerland be better off if the SNB did not impose its negative interest rate? Allow me to play through a brief scenario in this regard. What would happen if we were to simply stop charging negative interest in the current environment? Dispensing with the negative interest rate would have a substantial impact on the Swiss economy. Swiss short-term interest rates would again be higher than in other countries. Which would clearly increase the attractiveness of Swiss franc investments. This in turn would cause the franc to appreciate. Which would be detrimental to economic momentum in Switzerland and would see unemployment rise and inflation pushed into negative territory. If we stopped charging negative interest, Would that at least be beneficial for savers, pension funds, life insurers, and banks? Against the current backdrop, our unconventional monetary policy with the negative interest rate and our willingness to intervene in the foreign exchange market as necessary remains both essential and appropriate. Progress on Benchmark Reform Guy Debelle Deputy Governor keynote at ISDA's 34th Annual General Meeting. Hong Kong, April 11, 2019. Good morning and thanks to ISDA for the opportunity to speak here today. Monitoring progress on the transition and on ensuring that contracts referencing LIBOR include robust fallback provisions. Progress on adopting alternative risk-free rates. The transition from LIBOR to alternative risk-free rates. RFRs, is accelerating internationally. RFRs have been identified for all the LIBOR currencies by National Working groups involving the private sector and regulators. The rates chosen are overnight RFRs. Either measured from transactions in interbank unsecured lending markets or repo markets. It has now been a year since the Fed started publishing SOFR, the Secured Overnight Financing Rate, and since the Bank of England implemented reforms. To SONIA, Sterling Overnight Index Average. Recently, the ECB announced that it will launch EURO-STR, Euro. Short-term rate, at the start of October. These rates are more robust than LIBOR, since they are anchored in active liquid underlying markets. Usage of RFRs in derivatives markets is increasing. Futures and cleared swaps. Referencing SOFR have started trading, which is ahead of the schedule set by the ARRC, the Alternative Reference Rates Committee. Which is the U.S. Working Group on LIBOR Transition. There has been even more progress for sterling. Where trading in cleared OTC derivatives referencing SONIA is now broadly equivalent to that of sterling. LIBOR. The RFRs are also being adopted in some cash products. In bond markets in particular. A wide range of institutions have issued floating rate bonds referencing the RFRs. Since July last year. There have been quite a few deals referencing SOFR. The transition is further advanced for sterling. Where SONIA has been used in just over half of the deals this year. This has included 2 Australian banks issuing sterling floating rate. Bonds referencing SONIA. The rapid adoption of SONIA in the bond market demonstrates that RFRs can be used in cash products that previously only referenced LIBOR. Can robust term risk-free rates be developed in time? The currency most progressed on developing a term RFR is sterling. Regulatory, accounting and tax issues affecting transition LIBOR is deeply embedded in the plumbing of the financial system. So replacing it with overnight RFRs has significant and widespread implications beyond financial markets. One issue that has been generating quite a bit of angst in the region is the impact of the European Union's Benchmarks Regulation, BMR. Stephen S. Poloz, release of the Monetary Policy Report opening statement by Mr. Stephen S. Poloz. Governor of the Bank of Canada. At the press conference following the release of the Monetary Policy Report, Ottawa, Ontario, April 24, 2019. Third, we have been monitoring developments in the housing market very closely in order to understand how the effects of local tax changes. Changes in mortgage guidelines and past rises in interest rates would play out. John C. Williams, Fulfilling Our Economic Potential. Remarks by Mr. John C. Williams. President and Chief Executive Officer of the Federal Reserve Bank of New York. At the Association for Neighborhood and Housing Development 2019 Annual Conference, New York City. April 11, 2019. As prepared for delivery. Introduction. Thank you for that warm welcome. As you may be aware, last year I moved from San Francisco to take on the role of president of the New York Fed. In many ways, California and New York are like different countries. The weather is a big adjustment, for starters. But through my meetings with community leaders and visits to the Bronx and Brooklyn, I've come to appreciate that we're facing a lot of the same issues in my new home that I saw in the San Francisco Bay Area. The main topics of discussion: displacement as a result of gentrification, inequitable growth, and a critical shortage of affordable housing are all ones we were grappling with on the West Coast as well. These issues are complex and challenging. And there are no easy answers, so I want to start by saying thank you for all the important work. You do. There are a couple of topics I want to talk about today. The first is why the work you do is so important. and the second is the role I see the Federal Reserve Bank of New York can play in supporting you today. And going forward. Before I go any further, I'll give the usual Fed disclaimer that the views I express are mine alone and do not necessarily reflect those of the Federal Open Market Committee or anyone else in the Federal Reserve System. Dual mandate. Apart from a stint running a pizza shop, I've worked in the Federal Reserve System for my whole career. Nearly 25 years. And I'm not alone. When you ask people at a Federal Reserve Bank how long they've worked there, their response is often measured in decades, not years. What makes them stay? Economy's good performance. Recent work by my colleagues at the New York Fed crystallized the economic challenges faced by some of those living in New York City. Since the early 1980s, wage inequality has increased in the United States. But that increase in inequality has been particularly sharp in large urban areas like this one, in New York City and northern New Jersey. Someone near the top of the income distribution earns 7 times that of someone closer to the bottom. This contrasts with other parts of New York State, where the number is somewhere between 4 or 5 times. That's not to say things are necessarily easier in areas with less inequality. In fact, many of the areas with less inequality are also challenged by limited job opportunities and declining populations. It does mean that not everyone is benefiting from growth equally. One of the reasons for this is that the type of growth in the city has disproportionately benefited one type of worker. Growth in New York has generated demand for highly skilled workers. Who are often more highly paid and highly mobile. This drives up housing prices and contributes to gentrification. Which often goes hand in hand with displacement. Words like gentrification and displacement sometimes can feel impersonal or cliché. For some, gentrification conjures images of fancy coffee shops and high-priced fashion boutiques. But the reality can be heartbreaking. Families who've lived in a home for generations are driven out, communities break up. And the social fabric of a neighborhood is irreparably damaged. We seek growth that enables everyone to fulfill their economic potential. We want enterprise that supports communities. And communities that have the tools to flourish through investment. This is good for families, good for communities, and good for the economy. Of course. You don't need me to tell you this. You face the challenges of inequitable growth every day through your work. And that's why I'd like to talk about the role we can play to support you create a New York City that benefits. Every part of the community. When I think about our work at the New York Fed, both today and going forward, it boils down to three things: we connect organizations with data and research to amplify the power of their work. We convene stakeholders to share experiences and best practices, and we are a catalyst for initiatives and approaches that help tackle some of the most complex challenges confronting our communities. Connect some of our greatest assets are our data. Analysis, and research. And I don't say that only because I am an economist by training.